All right, section 13.4 is the costs and advantages of home ownership. We're going to talk a little bit about some details throughout this. Some of these are just like definition things. Part of what this lesson is about is making sure that you kind of know what this looks like, because at some point you're probably going to try and buy a house. Like, that's realistic expectation that most of you probably have. And so you should probably say, you know, I remember there were some of these things that I learned back in that one class. And at the very least, at that point, you can figure out, what was that title again? What was that description again? What am I signing up for? Because it's probably a really good idea when you sign the paperwork, because I will tell you, when you go to sign loan paperwork, you're like signing your life away. You sign so many pieces of papers, it's crazy. And it's probably a good idea to know what you're signing. So we're going to take a look at some definitional things. We're going to look at some computational things as well. Mortgage. Mortgage is simply a home loan for a substantial amount over a lengthy time interval. Has some other names. It's also called a deed of trust or a security deed. So they all mean the same thing. It's an installment loan. It's just that it's a big installment loan. So it's got some caveats to it that others don't. Down payment. Down payment's the same thing we talked about before. The down payment is the portion of the purchase price that the buyer pays initially. That's what down payment went for our refrigerator, and that's what it meant when we did the dishwasher. That's what it means when you do a car down payment. It's all the same. Down payment is down payment. Term. Now, term is used specifically in mortgage language, but it's the same thing that happens in the other loans as well. Term is simply the time it takes until you pay it off. So are you signing up for a 20-year term? Are you signing up for a 30-year term? Are you signing up for a 15-year term? Right? Again, it's given in years. Okay. Principal amount of the mortgage. The principal amount of the mortgage is the purchase price minus the down payment. It's what you're financing. Right? Not the finance charge, but the actual financed amount. So if you go in and you are getting a $100,000 loan and you pay $3,000 down, then the principal amount of the mortgage is $97,000. It's just the subtraction. We did this with the refrigerator. We did this with the dishwasher. Not any different. There's a couple of different kinds of mortgages that we're going to take a look at. The first one is called a fixed rate mortgage. Okay? Fixed rate is a good thing. Fixed rate means that nobody can change it from you later. And that's really good. Right now, if you had a fixed rate mortgage from about a couple of years ago, you're in a really good position. Because if you did not, interest rates are rising on fixed rate mortgages, which means anybody who has a non-fixed rate mortgage is about to see their interest rate go up. Because that's the market that we're currently in. And you don't know what market you're going to be in when you buy. So fixed rate mortgages protect you. The interest rate on the loan will remain constant. It will not change. Amortization is a really funny thing. So amortization is this big giant table. So you remember when you guys did the tables with me on like the credit card tables? And it's kind of like that. It's kind of like that kind of table, but what it does is it shows the entire length of the loan by month. So if you have a 30-year mortgage and there's 12 months in a year, 30 times 12 would be 360, good. It's a table with 360 lines long. So imagine a spreadsheet, 360 lines long. That's an amortization table. That's what it is. Okay? What it does is it actually shows the initial balance, like how much you're borrowing to begin with, and then the interest that you're paying as you're working your way through. And it's very interesting because what it will show, and you'll see in a moment here, is it shows like on month one, this is the amount of interest you pay, and this is the amount of the loan that actually gets paid off. And it's highly discouraging. I'll just tell you that right there. Because it's really, really big on the interest at the beginning of the loan and really, really small on the principal of the loan. So it would not be uncommon maybe for you to have a $1,000 payment and only like $200 of it go towards the actual cost that you borrowed. And the rest of it's just interest, dumping off interest. It's crazy, okay? So typically these are monthly payments. There are some amortizations that can be done with biweekly payments. Do you know what biweekly means? Every 2 weeks, yeah, every other week. So if you have jobs, sometimes they're paid biweekly. Some jobs will do that. And so what ends up happening in a biweekly payment is that you end up with how many payments in a year? What would biweekly mean? 26. There's 52 weeks in a year, so you'd have 26 payments in a year. Whereas if you were doing a monthly payment, you'd have only 12. They'd be bigger, but you'd have only 12 of them. So they change things a little bit if you're doing that. Mostly, we do monthly payments, though. All right, so here's the first formula for you. This is the payment that's required to repay a loan of P dollars together with an annual interest rate, R, over the term T years. So you see P, R, and T in there, kind of like when we were doing some of the interest stuff from before, taking on a little bit of a different nuance. And then the last thing to be aware of at the moment in terms of definition stuffs is closing cost. Closing costs is what they're usually called. They can also be called settlement charges. These are imposed when the loan is finalized, i.e. at closing. So you've probably heard somebody say something, whether it's your parents or somebody you know who has purchased a home or whatever, that they want the seller to pay the closing costs. Have you heard that phrase before? Yeah, there's costs associated with closing on a house. There's a title fee, right, to make sure that you really own the house and the neighbor doesn't own the house. There's fees that go to the realtors. So closing costs involve all these sort of extra fees that really have nothing to do with the cost of the house directly or paying it off. They're additional things that cost. All right, back to Ann and Andy. Ann and Andy decide they're ready to buy a home, and they find the perfect house. They negotiate with the realtor a purchase price of $120,000. They qualify with their credit union. Credit union is like a bank for a $100,000 fixed rate loan with 3.75% interest on a 20-year schedule. That'd be fabulous right now, by the way. A few years ago, that wouldn't have been great, actually. That would be really good right now. All right, so we're going to do this step-by-step thing where we find a lot of these quantities. Some of them we've found before, some of them are new. The first one is the down payment. So what down payment must they come up with when they go to closing? $20,000. So the cost of the loan, the cost of the home, is $120,000, and the amount that they are being allowed to borrow is $100,000. So they have to bring $20,000 to closing, just for the cost of the house, not for the extra closing costs, but $20,000 for the down payment. Okay. Regular monthly payments. So that's the R. Let me write that down from this previous screen as well. So you have R equals P times a little r over 12 divided by 1 minus 12 over 12 plus r, and this is raised to the 12t. That's the formula that you wrote down on the previous page. We know a few of these things. In fact, we've been given all of them to some degree. What is P? 100,000. So P is the price that they're borrowing, like what they're borrowing, the loan amount. So P is $100,000. R. What's R? Yeah, that's the interest rate that we were given over here, 3.75%, so 0.0375. If you're finding yourself making errors on problems, those are things to check, right? Check to make sure I really put in the number of years. Check to make sure I really put in the right interest rate as a decimal, that kind of stuff. How about, let's see, the denominator is 12, okay. Now my larger denominator, I have 1 minus, and I have that same 12. And the denominator is supposed to be 12 plus r, so that's 12.0375. Yes? Looks good. Raised to the 12, t. What's t? 20. T is 20. Okay, so again, be careful with your calculator. That's another thing, I cannot mention it enough, depending on what, operating system your calculator is using and how new it is and things like that. It might do funny things with order of operations. So it's not a bad idea if you feel like this answer didn't quite make sense, or if you're doing the homework and you're finding out for sure it didn't work, to go back and just simplify little pieces of this along the way, right? So like an entire numerator, we can do the entire numerator really well. 100,000 times 0.0375 divided by 12, that your calculator will be able to handle. I'll write that down. It's actually 312.50 or 0.5. The denominator is a little messier if you're working with your calculator. So you might actually, I mentioned this, sorry. Goodness. I'm okay, yeah. I mentioned this when we did compound interest, that we might want to just find the exponent values before we move on. So this one, 12 times 20 would be 240, so you might want to do that. And then if you put some parentheses around the part that's in parentheses, your calculator should be okay again. So 1 minus, do the 12 divided by the 12.0375, raise it to the 240. And I want to keep a lot of decimals and round at the very end. So I'm going to write a bunch of decimals down in my denominator, probably overkill, to be perfectly honest, but I would rather have overkill and not have an error, so I'm going to write down a lot of them. How many should you write down? Probably at least 6. I think 6 is a pretty safe number without it being overkill like mine is. Probably at least 6. And then we're going to divide. 312.50 divided by the 0.527-ish number. And at this point, we will, in fact, round to a dollar amount because what I'm finding is a monthly payment. Monthly payment would be a dollar amount. So what is this when I divide it? Okay, anybody else get that too? Okay, got some head nods, good. Yeah, that's our monthly payment. So we've got an almost $600 monthly payment. So a few things here that I'd like for you to be aware of. A conservative here in this sense means cautious, careful, right? A conservative estimate for home ownership is to use a 15-year fixed rate mortgage with 20% down that will cost you no more than 25% of your monthly take-home pay. And I will guarantee you the lending institution will let you do far beyond that. So when we had a house in Ohio, our lending institution allowed us to borrow 47% of our take-home pay. That's called being house poor. If you spend 47% of your take-home pay on your mortgage, you will find yourself very, very stressed. You just can't do anything. So this is conservative. It's cautious, being able to be cautious with your money. Also having the money down, the 20% down. Not a requirement for most loans these days. Sometimes there's extra fees if you don't acquire it, and some people get really anxious and they want to do that loan thing sooner and so forth. The problem is that sometimes housing markets crash. That happened to us too. We borrowed too much and the housing market crashed and we lost $30,000 on a house in Ohio because we borrowed more than we should have at the time. Things happen and you just don't know. So these are the kind of like safeguard things that keep you protected, and that's what they're for, and those ideas. And this is from Dave Ramsey too, by the way. So we're going to take a look at a mortgage table for this particular situation. They did do a 20-year note, not 15-year note, but they almost had 20% down. It's awfully close. They had a $20,000 and a $120,000 loan. It's very close to the 20%. We don't really know what they're making, so we have no idea if it's too much for their budget. But here's what this is just the first 2 lines of an amortization table. Nobody's going to have you do a 360-line one, okay? It's not going to happen. I think 3 or 4 lines is like its maximum that it does or something like that. But I will say the tricky thing with these is that if you get off in one of your rows, the whole table gets off. So you want to be really careful as you're working through this not to be off by decimals because it will affect the outcome of every single cell. And as you know, when MyMathLab does that, it calculates every single cell as a different point value in your problem. So be careful. Now, this payment column right here, this column is the same every time. Like every entry would be the same. So if you were to get the 240 line, this is 240 lines because it was 20 years, a 240 line amortization table, this first line, the total payment is the same every single month. And we calculated it on Part B. It's that regular payment amount. What was the amount that we had on Part B? $592.89. So we can automatically put that in to every line that we are requested to do. It will not change. Okay, so no matter what happens, if we did Part B right before we ever got here, part of this amortization schedule will be correct. Okay, because that's giving you that from the get-go. All right, so we need to figure out how the monthly interest part works and how much the amount's going towards our actual principal. This is the part where I told you is a little discouraging when you get a first one of these because so much of it goes towards interest and so little pays off the house. So we're going to take a look at the first month because it changes every single month. Okay, so the second column Whatever we get for the first box will not be the same as the second box. Okay? All right, so we'll take a look at month number 1. So in month 1, we want to take a look at the interest that we're going to pay. And the interest is found by the same formula that you've seen many times before. I equal PRT. Okay, so it's showing up again. I'll actually write it in here for a moment and then we'll use it. P is the principal. It's how much money we still owe on the house. So when the first of the house beginning, the whole beginning of our loan starts, what did we borrow and have to owe on the house? $100,000. But that's going to change after the first month, right? Because after the first month, a little bit of that's not going to be owed anymore because we would have paid it off. So that $100,000 is going to keep changing for every line of your amortization table. The rate is not, though. The rate that we were given will stay the same. So what is the rate? Yeah, it's the 0.0375. What's the time? Okay, so that's the time for the whole loan, but I want the time frame for the first payment.
1/12.
It's 1/12. Yeah. The first month is 1/12 of the year. Does that make sense? So as we're working through this, as long as it's monthly payments, and I think all yours are, this time will always say 1/12. Okay, so the 375 is going to stay the same. The 1/12 is going to stay the same. This number at the beginning is going to change every time I do my amortization schedule. Grab a calculator, multiply this out. What do you get for month number 1's interest? $312.50. And that's what will go in the second box. Okay, now think with me. If I'm paying $592.89 and $312.50 is going to interest, how would I find out how much is going towards the principal? We would subtract. Yeah. So to get my principal payment, we would simply subtract. Payment. I take the $592.89 and subtract the $312.50. What does that give me for my principal on month 1? $280.39. That's a little depressing. And that's a good interest rate, right? At least by standards of this moment right now. That's a good interest rate. The first interest rate we had on our first house was 7%, and it was a good interest rate at the time. Yeah. So this number being bigger is actually going to make your interest higher. Interest higher means paying off the loan slower. Another thing that pays off the loan slower is the number of months in the loan, right? You take out a 30-year loan as opposed to a 15-year loan or a 20-year loan. Your payment's going to be higher for sure, but you're going to pay off substantially more principal each month because of that. So you get the numbers down quicker. All right, so this number, $280.39, will go into the box right here. What do you think the balance of the principal means? Close. How much is left from what you've paid off? Yeah, so you're talking about the same thing. So the amount of the loan originally was $100,000, right? After month 1, we have paid $280.39 toward that $100,000. Now, it's not very much. Agreed? We've got a long way to go. But it's less than $100,000 at the end of that month. So our balance is that $100,000 that we started with, minus the principal payment that we made from line 2 here or whatever, $280.39. And if you calculate that, what do you get? Say it again. Okay. Everybody have that? I know not everybody's putting in the calculator, but those of you who are, did it work out? Okay. That goes in my ending column. $99,719.61. So what do I do for month 2? Well, I do exactly the same thing, but the numbers are altered slightly. Because I no longer owe $100,000. I owe $99,700 and some change. So I'll shrink this, and then we will follow the same process for month 2. Okay, so for month 2, my interest. I equal PRT. What's P this time? 99,719.61. But as we mentioned before, the rate is the same, 0.0375. And the time is still 1/12. Do you expect it to be higher or lower than the 312.50? Lower. I owe less money, so I should now owe less interest, right? But it shouldn't be a lot lower, right? It should be close to the 312, but it should be smaller. So if you make this calculation, what do you get? 311.62. It's very close, actually, isn't it? Did not change that much. So this is 311.62. Less than $1 difference, but it is less. So how would I go about finding my principal payment? The same regular monthly payment, $592.89, and I subtract my new interest payment that I just calculated. So my principal payment is $589.92. I didn't write that right, $592.89. Minus my $311.62. What does that give me? $281.27. So it's slightly more. And again, that should make sense. As we move down this table, the interest column should be decreasing. Well, I should start with here. The total payment column should be staying the same. The interest column should be decreasing, and the principal payment should be increasing every month. What should the last column be doing? Decreasing, right? Because we're paying off the loan. How do I find my balance of my principal in this? So I've got had 99,719.61, and I'm going to subtract the 281.27 that we just found, because that's my principal payment. And what do I get?
99,435.34.
Okay, 99,000. Oops, did somebody get something different? 438? I might have just heard you wrong. You wrote wrong. Is that okay? Okay. 438. 34. And again, if you're off by a penny, moving through here, a couple of pennies, like we're not going to split hairs about any of that stuff. I'll fix it on the end, on the other end of things. But as you can see, if you are off, it follows, right? It's going to follow you through in a number of places if you get off somewhere and you're working on these. The thing that's really freaky, what happens when you get one of these like schedules when you go for a house loan, is that at the very end, they add up the total payments. They tell you how much they add up the total interest. They add up all these totals at the bottom. You know, kind of like your spreadsheets can do that, right? They add up all these totals. So when we bought our first house, it really was a $100,000 house. That's actually what we had. It was right at $100,000, and we really did have a 3% down payment. 3. That's not good. So we borrowed $97,000. That's what we did because we were stupid. And in doing so, when we got to this point of this paperwork, if we had paid that loan off, we would have paid for a $100,000 house $279,000 because we also got a 30-year note. We did a lot. And a 7% interest rate. Yeah, scary, scary stuff. Okay, let's take a look at a few other things in this packet. People like to talk about all the time it being cheaper to own than to rent, but that's not exactly a true statement. There are other costs associated with the cost of the home besides the mortgage. And so there's a few things that you should be aware of. Property taxes is one of them. Property taxes are collected by a county or other local government, and they can cost up to several $1,000s annually. Both property taxes and mortgage interest are tax deductible. So what does it mean for it to say that it can, or that's not what I meant to say. What does it mean for it to talk about being collected by a county or local government? So there's a couple of ways that you can have your property taxes paid. One of them is through something called an escrow. It's actually pulled out automatically from your bank. A lot of banks require it to be done that way. The other one is that they can send you a bill at the end of the year and just tell you what you owe. So we have ours sent as a bill at the end of the year, because what happens if you have it escrowed is that it's actually like you're paying it all the way along. And so you're like prepaying for things that you don't need to pay for yet. They're not due. So we have ours sent to us. Several $1,000s. So yeah, ours is about $3,600, $3,600, except last year it was $4,600. Why? Because there's some bond issue that was passed at the school district, and it changed everybody's property taxes, and it was messed up. So it was supposed to be spread across 2 years, and it wasn't. It was like all dumped into 1 year, and so it increased our property taxes by $1,000 for that year. That was painful. That's what it was. It was very painful. So property taxes is not a cheap thing. It's just not. And it's something that people sometimes sort of just overlook or kind of ignore when they're looking at the cost of home ownership. Another one is homeowners insurance. Homeowners insurance covers losses due to lots of things. Fire. My parents suffered a devastating house fire when I was in my senior year of high school. Completely destroyed everything. Absolutely everything. And so yeah, storm damage. We live in Oklahoma. Storms happen, don't they? And not just tornadoes, but like hail and wind. Those things happen too. So that's actually covered. Other casualties too. So things like potentially, depending on your homeowner's insurance, flood or water damage in certain ways also get covered. It also provides liability coverage if someone is hurt on your property. So if somebody gets hurt playing in your backyard on that trampoline, did you know that you're liable for all those medical bills? You might have a nice neighbor that doesn't make you liable, but you are liable, and your house insurance is actually what covers that. The other thing that people often sort of ignore is maintenance. Oh, so homeowners insurance. Homeowners insurance varies drastically based on where you live, like drastically different. So our homeowners policy here in Oklahoma is substantially higher than our homeowners policy was when we lived in Ohio, because we live in Tornado Alley. There's a reason for it. Like you get the why, but it's just the way it is, right? So it varies a lot. It doesn't just vary based on the price of the home. It varies about the location of the home too. Maintenance. Maintenance varies by home due to its age, construction type, size, and condition. Things break. Shocker, right? Maintenance. Maintenance that happened to us when we bought the house that we're in right now that we did not expect and had no idea was that we have a water well and we have a septic tank. And nobody told us that you're supposed to do such and such, whatever it was. And I don't even remember now, because I don't do this stuff. My husband does all the maintenance stuff in the house. It would be doing double duty for us to both know these things. He knows that stuff, right? But we didn't know it at the beginning. And shortly after we moved in, we found out, it was a few months afterwards, that there was a $700 bill we had to pay for something because we weren't maintaining something properly because we just didn't know. And we weren't expecting a $700 payment at that point, right? Maintenance. Maintenance sneaks up on you. It's a problem. Okay, so let's go back to Ann and Andy. So we're going to find their total monthly payment if their annual taxes cost $932 and their annual insurance costs $660. So this is much like an escrow account would do. An escrow account is the bank managing the price that you still owe back, like the loan, and then also managing the interest, I can't talk today. Insurance, the insurance that you owe, and the property taxes. And so they try to like level it all out for you so that you're making sure you're covered at the end of the year and you don't have that sneaky bill coming up that's $1,000 more than you thought, like we did. That's what escrow is trying to do for you. So we already know what their regular monthly payment was. What was their regular monthly payment? Whoops. The regular monthly payment was $592.89. What about their taxes? We want to know their monthly taxes. Well, their yearly taxes is, what is it, $932? How would I find their monthly taxes? Divide that by 12. Do that for us. $77.67. It's not too bad. How about the insurance? Okay, and how'd you get 55? Yep, same thing. So the 660 divided by 12, and that's 55. So how would I find out their total payment? I'd add them all up. 592.89 plus the 77.67 plus the 55. And what would their payment really be? $725.56. And it's worth mentioning that the taxes and the insurance, you don't have to do those if you're renting. That said, you should still look at renter's insurance because it's dirt cheap anyway, and it would cover your personal effects if something happened to the property, whereas the homeowner is not responsible for covering your personal effects if you're renting from them and something happens to the property. But these amounts just simply wouldn't be there if you were renting, right? They wouldn't. So some financial advisors recommend that you should not pay off your loans, your home loans, especially early. Have you ever heard that before? It's a really popular one here. Because you lose a tax write-off. So you'll have to pay more money in taxes. So you should hang on to your monthly mortgage because then you'll have to pay less in taxes. That's the argument. So we're going to consider if this is good tax advice within the context of Ann and Andy's situation above. Ann and Andy's loan was a $100,000 loan at 3.75% interest. We already have those details. So how much money, approximately, would Ann and Andy pay in interest the first year? Well, y'all know how to find interest. How do we find it? PRT. Now, this is not exactly perfect because what we really should do is we should look at an amortization schedule and the interest changes slightly every month. But this is a very nice approximation to at least judge the accuracy of this statement, which is what we're looking at right now. So it's a $100,000 loan. The interest rate is 0.0375. And the time is 1 because it's 1 year, right? So how much is the interest that they pay in year 1, approximately? $3,750. It's not exactly perfect, but it's pretty close. $3,750. So the amount of income that Ann and Andy will pay taxes on will be decreased by the above amount. It doesn't mean that they don't pay $3,750 in taxes. It means that whatever income they make, you can take off the $3,750 and then you only pay taxes on that remaining part. So basically, they're not going to pay taxes on this amount. That's the way it works. So we're going to take a look at putting them in a general 25% tax bracket. And this 25% is sort of irrelevant to the discussion. It doesn't really matter if it's 25% or something else. The argument will still hold. I just need something so I can show you how it works. Okay, so we're going to assume a 25% tax bracket. Okay, so how much does this savings create for them, right? Well, they have $3,750 that they don't have to pay taxes on. And that means they don't have to pay 25%, that's 0.25, of the $3,750. Does that make sense? That's what they would have had to pay if they were, say, renting, and this was in there, right? They would have had to pay that. So what is $3,750 times 0.25? $937.50. Now, if they've already got the mortgage and they aren't in any position to pay it off, are you going to take the $1,000 tax break? You betcha. I mean, if they wanted to tell you that you owe $1,000 less in taxes, none of y'all are going to complain. You're going to be like, score. But that's not the issue here. The issue is whether or not it's a good idea to hang on to the mortgage if you could have paid it off. So here's the deal. Ann and Andy are paying the credit union $3,750 in that first year. To keep from sending the government $937.50. So if they're actually able to pay off the mortgage, would it make sense for them to delay doing so? No, because they would be paying less to the government than they were to the mortgage company, right? Not only that, but there's other ways to, they call it shelter your income like that too. If you don't have the mortgage payment, you can give it to charity. Your churches, Mission 1010, that's my charity, right? Like you can give it to charities and you can do the same thing as if it were your mortgage payment. All right, I've mentioned a few other of these things. We're just going to run through them really quickly. These are things you should be aware of. Escrow, I've mentioned this before. It's a reserve account maintained by the mortgage lender. The taxes and insurance are collected up front from the borrower and paid by the lender to the respective agencies. So they reset this every year, so your monthly payment changes a little bit, not because the payment does, but because the the insurance and the taxes change slightly every year. That's a normal thing for it to happen. So your payments do change. Adjustable rate mortgage or variable rate mortgage. Just write yourself a note that said these are scary. These guys are not a good thing. And they sound really good. Because right now, for example, if you were going and you were getting a loan and it cost you 7% for the loan, if you go and you try to get an ARM or a variable rate mortgage, you might only pay 2%. That might sound really good. And it probably would until the interest rates go up to 10 or 12%, and then your ARM goes up, and then they call it and they make it a new fixed loan on you, which can happen. So these are not generally a good idea because they can change, and you have no way of knowing what they're going to change to and when they will. And these are the kinds of things that adjust, or quantities that can govern the ARMs. The adjustable period, how frequently can they make adjustments? It's typically 1, 3, or 5 years. So it's set for a year, and then it might come back to bite you. Or maybe it's 3 years, or maybe it's 5 years. The index, the standard fluctuating average that is the basis for new adjusting rate. Right? That's what we see. That's why we see interest rates go up, as the index goes up. The margin, the additional amount added to the index by the lender, typically a few percentage points. There's a luxury in borrowing money, right? They're not doing it because they like you. They're making money, and that's not a bad thing. It's just you should be aware that they're making money. It's a business, right? It's a business. Discount. The discount is the amount by which the initial rate may be less than the sum of the index and the margin. A few more. Index rate cap. This is the limit on the interest rate increases. So it might have a limit where it says it can only go up 1% every year. Right? That's what that's talking about. Periodic cap. A limit on the rate increases per adjustment period. Oh, this is what I was meaning. I'm sorry. The cap is the actual amount that it would go up. And this is the per time frame period. The first one is the total. So about 1% every 6 months or 2% per year. The overall cap is the limit that the rate can increase over the entire life of the loan. Right? There's a cap given to those, typically about 5%. The payment cap is the limit on how much the payment can increase each adjustment period. So how much can your payment go up? It started at $589 for Ann and Andy, and if they had an ARM, well, maybe they need a cap. They would have a cap. There would be a cap. It might be $900. Well, $900 is very different than $600, right? But there is a cap. Negative amortization. This is terrible. So remember on our amortization table, we talked about how this column is doing this, going up, and this column is going down over time. And the final column, that running balance column, it was going down, right? Because we owe less money over time. But when you have an ARM, sometimes you end up owing more money over time. That's not good, right? That's negative amortization. Convertible features is a feature inside of the contract that allows you to switch it from the ARM, the adjustable rate mortgage, into a fixed mortgage. Like there's a condition or clauses in there that allow you to do that and descriptions on how you can do that. And then we've already talked about the prepayment penalty, the charges imposed by the lender if your payments are made early. That's it.